Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is Alexandra Canal. The People's Voice is on assignment. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming for the first time James E. Demert. He is a founder and CIO of Main Street Research, a $2.4 billion registered investment advisory firm. He has over 40 years of experience and has authored 3 award-winning books. His latest is called Wall Street Lessons, which explores behavioral finance and investor psychology. So welcome, James. And today we're going to be leaning into investor psychology throughout the show, along with a heavy dose of markets talk. But first, we're going to focus on the upheaval in U.S. policy, which is reshaping global economics, leading to our phrase of the day, New World Order. How trade wars, tariffs, and friendshoring are reshaping global economic power and markets. And this episode is brought to you by the number 13. That is a number of psychological blunders investors make, according to James. We dive in carefully. So James, we're taping this right after the first 100 days of Trump's presidency here. We've seen a lot of volatility. What are you making of all of it?
You know, I think the market is expressing what's happening internally as the administration just really changes policy, economic policy that was in place for, decades. So this market was investors overconfident at the beginning of the year, probably a little too complacent. An overdue correction turned into something much worse as those tariffs came in much more extreme. Then we sort of sold off to a very oversold level, high level of bearishness, which we can talk about psychologically.
Yes.
And now we're sort of seeming to be on right in the middle, about the middle of that correction. And we would suggest here, investors should be really careful. The new leadership from here is going to be different than what was happening last year and the year before. And there's still risk here, certainly of going down and testing the lows, maybe even going lower. So this is a time to really have your wits about you.
So this is a good time to pivot to our phrase of the day, which is New World Order. It describes how shifting geopolitical policies like trade wars and tariffs and friendshoring are reshaping global economic power, changing the investment landscape. So the phrase kind of reminds me of the Latin motto on the Great Seal of the United States, Novus Ordo Seclorum, which means New Order of the Ages. It's right there on the dollar bill, and it was coined by the founders to highlight America's emergence as a radically new economic and political force. So I'm wondering, are we seeing echoes of this? How much of this is due to Trump? How much of it was just inevitable because the old ways were just getting sclerotic and stale?
Well, I think that, the policies that this administration has really changes the world economy significantly. You've got a U.S. being much more protectionist, obviously with the tariffs. You've got a U.S. policy within Washington being more fiscal austerity. Basically what that all does is it turns down the spigots of growth. So it should be no surprise that this morning we have GDP coming in a little negative. There's other reasons for that, maybe a little more pronounced than it needs to be. But I think investors should recognize all these policies that don't look like they're going to be reversed, at least in total, are going to lead to slower U.S. growth. And the American exceptionalism, which we've been living with now for decades, might be in question here. And that's why we think investors should also look overseas, where there's changes also occurring because of U.S. policy. They're changing in a fashion that might give them better growth.
Do you think this is a fundamental shift? You know, every 4 years we sometimes continue on with the current administration. Sometimes we get a new president. But do you think what's going on now, even if things are reversed, even if in 4 years we have a Democrat president in place, he has different policies, he or she, I should say, is this, a new order that might last longer than the next 4 years? Right.
Yeah, Ali, I think that's a great question. One of the problems we have in the U.S. before this policy even got started is we have an overburdened amount of debt. And that was just escalating out of control. I'm not sure this is the right way to handle the debt, but I don't think we go back even after 4 years with a new party, because the whole idea of getting our debt level more manageable is really important for the success of this country. So a lot of pain now, so later on we can be healthier, and markets are obviously exhibiting that pain certainly in the last few weeks. So our view is the global economy is going to be tilted. It's going to be different now for the next, let's say, 5 to 8 years until the U.S. economy gets in better health, and that will create opportunities, certainly in parts of the U.S. market, but also outside the market, the U.S. market, which has kind of been ignored for the last.
Let's talk about those international markets. I know you're keen on that, and we've seen other countries like Spain just had it is having a blockbuster month in time, despite their loss of electricity the other day. But talk about these international opportunities.
Well, what's interesting is what's happening outside the U.S., particularly overseas, is you have the opposite. And here we have the fiscal restraint and we have monetary policy tight. There, because the U.S.'s withdrawal of funding, particularly in countries like Germany, they're having to turn on the fiscal spending. That's hugely stimulative for the economy.
That's big for the Germans too, because they're very inflation wary because of the old times.
That's exactly right. But they've committed to billions of dollars of spending over the next, not just 1 year, but over the next 4, 5, 6 years. And that's going to be very stimulative to the economy. That's why you're seeing those stocks, after years of just lingering around, starting to hit new highs.
Yeah, so I'm curious, and it's interesting to hear that ripple effect there too, right? Because the U.S. is restricting funding, now you're having all these fiscal measures overseas. What are the investable areas then in that case? Is it sort of looking at these currencies? How are you assessing that?
In the U.S. market or
overseas,
globally?
Yeah,
overseas, you really want to think about where, if we're going to stimulate those economies, where is that earnings growth going to be? And generally speaking, at the beginning of what I would call a new cycle there, you want to go to those cyclical industries, the industrials, the financial companies. And there's a lot of really great quality companies there. Telecom is another example. I think the whole market there, but I would stay away from maybe the consumer staples overseas and focus more on those cyclical names. Certainly the euro currency has done really well versus the dollar. That's another way to play it.
What about for U.S. investors who are, we've had the fortunate experience of having these exceptional markets for the last few decades where it was the place to be. How do you dip your toes into these international markets where the average person might not be familiar with some of these German industrial names? How do you find them? What kind of filters do you use? What sources do you look at?
Yeah, our name is Main Street Research, and that last part is about the research. We love digging in. We only use individual securities, so we look all over the world for great opportunities. And we use a lot of research just in-house, looking at companies publicly traded, how much debt they have, what their earnings are. We like companies with high cash flow, return on equity. And we like them in certain sectors, Ali, as you were mentioning, that might have that earnings lift with all this stimulation that's going on with the economies.
So let me bring it back to kind of the new world order here. It seems like every few decades we get a big break in the action. I could go back to World War II, where right afterwards we had the Bretton Woods Agreement, and that was a regime of global fixed currencies. That gave way in 1972 with Nixon closing the gold window. Then we had floating currencies, and now it looks like we're morphing into something different. And we have kind of a template of what Trump might want to do in terms of the Mar-a-Lago Accords, and that has, there are a few pillars there. It's deregulation. It's getting the rest of the world to kind of shoulder the security burden by taking on longer term U.S. debt. We're talking 100-year bonds that haven't even been formed yet, which don't even exist yet. How are you deciphering this? And are you looking for opportunities based on all of these recent developments?
Yeah, we are looking for opportunities. And I would suggest that investors not to ignore, Jared, the U.S. market, just be a lot more selective than they've been or had to be for the last 5 or 10 years. I like that you brought up the Bretton Woods and some of these earmarked places where the economy's changed for many, many years. I think we're kind of in that position. The U.S. has to be very careful here to walk a fine line to not put the economy in harm's way. I think that's where the Fed is going to be very important over the next year or two. But there's select great places here. If you think slower growth in the U.S., what kind of companies thrive in a softer economy? And I think also investors should not disregard that artificial intelligence is real and it's going to have a lot of tailwind.
I was going to just ask about that because tech, the fundamental story there is still the same, right? Even though we have a lot of the uncertainty, AI is a big play. So how do you view more of those high growth names, the tech sector overall?
Well, AI could easily get us out of this pickle with debt, right?
That would be magic.
Yeah.
If we can get better productivity growth, which is what it should bring, and we've already seen it has, that should fuel better corporate profits, even in a slower economy, which helps get corporate taxes to come in and fill that hole. So we believe that AI is an important part of a portfolio, and I think investors here really should look at, those leaders in AI. A lot of them reporting. We have Microsoft and Meta tonight reporting, Amazon, Apple tomorrow.
So is it the hyperscalers or the knock-on kind of side bets here?
We think you go with the best in breed. So when you go to the semis, you go to NVIDIA. When you go to the second tier, right, that second derivative, you go to the Metas, you go to the Googles, which numbers were good. And you can buy them now at growth rates up here, but PE ratios finally lower than those growth rates. So stick with really high quality names. I don't think investors should overdo it on their tech exposure, like maybe worked for them in the last few years.
So maybe take some of that tech overexposure and look elsewhere, overseas maybe.
Get your passport, Allie.
Yeah. Oh, I'm going in a couple of weeks. I'm excited.
What about China? China has just been an incredible story, and it seemed to have been uninvestable for a period of time just because of the very arbitrary seeming policies of the Chinese government. But last September, we got a wake-up call, and they just released this bazooka stimulus. They've done some follow-up and follow on, and now, of course, tariffs is the main story with China. Do you see that China as investable?
It was uninvestable. There was every metric you look at, just stay away. And they threw everything but the kitchen sink at this, right? Lowering
We're still
rates.
waiting for the kitchen sink, though.
That's the last thing to come. They've used fiscal stimulus. They've used everything they can. And our view of China about 6 months ago is that, hey, we got to be getting close to investable. But here you have to also think a new world order. They can't export as much to the U.S., or they probably won't. So look at companies like BYD. Right, the electric vehicle maker, they don't even do business in the United States.
Bigger than Tesla, in certain respects.
That's correct. And they do a lot of business in Europe and around the rest of the world.
All right, hold that thought. We need to take a short break, but coming up, we're going to be talking about the 13 psychological blunders investors make, from FOMO to TINA, and a magical who wore it better where investing meets illusion. Stay tuned. This episode is brought to you by the number Lucky 13. That is the number of psychological blunders that James here identifies in his book, Wall Street Lessons. Here is a sampling: FOMO, TINA, permabear, permabull, confirmation bias, loss aversion, fear of capital gains tax, sunk cost and lost opportunity, deer in the headlights, procrastination, information. And I like how information is on its own line there as a potential blunder, but tell us how you approach some of these concepts here in your book.
Yeah, we have the book right here.
Thank you, James.
Thank you for showing the book. 40 years of doing this, I've seen and heard investors' horrible mistakes, almost always related to their own psychology. Right? Our human brains are just not great at investing. We can be our own worst enemy because of fear and greed. And I think the recent months in the market are a really good microcosm. People were too optimistic at the beginning of the year, investing too aggressively. And now you find people don't even want to go near the stock market, and they think it's uninvestable. So I've learned a lot of things over the years.
So how do you, as an average investor, let's take a beginning investor, how do you approach the field of investing without having to rearrange your brain and going to a therapist every week? Because really, there's a reason why professional traders often say retail usually, if not always, gets it wrong, because they're at the lows. There's just this pervasive fear. That's when people tend to get out and they think, okay, I'm going to get back in when things are good. But guess what? The market's already back up at highs, and then it's too late, and you're sitting there on all this cash. That is a pervasive problem, and I've been there myself, so I'm not immune to that. How do you approach that?
Well, the first thing I would suggest is, if you haven't seen therapy or you can't work on yourself to try to retrain your brain, which is really hard to do. I'll speak as a biased investment manager. Get a partner to help you. Get an advisor who can see through the psychological ups and downs and give you advice that sort of gets you away from your own brain making those mistakes. But second to that, and the book really goes through this, use tools and techniques that will create a discipline for your investing. Let's say, for instance, I shouldn't have more than X percentage of stocks at any time. So that, and if I keep that rule, let's say 60% stocks, even in a raging bull market, it reminds me, I got 60% in, let's not increase it. That's where people get in trouble. They start to invest more than they should and more aggressively. I think also in this market particularly is a really good example is be wary of the sectors you're investing in, right? There's a lot of sectors maybe that are beaten down that people ignore because the trend isn't there, but they're safer, and that's a good way to diversify. And lastly, use tools like stop loss orders. They stop the loss of catastrophic decline even in any market. So we can talk about that more. But again, use tools and strategies and commit to those as an investor, or use an advisor that does, either way.
We were just talking about AI, and I'm curious how you think AI or robo-advisory tools are changing the investor psychology. I mean, I'm not gonna lie, sometimes when we're having a bad day, ChatGPT can help me out a little bit and can be my little AI therapist. How do you view the role of AI in all of this?
Yeah, Chad is one of our best friends, right?
Yes.
But the problem with so far robo and that field, it's not come up with very good investment ideas or metrics, and ChatGPT is not good at math so far. But I think that will change and evolve eventually. One of the problems with humans and their investing, even given a model that, okay, I won't touch this, I'll let this model do what it needs to do, it will save me. Generally speaking, when things look really bad, we go unplug the model to stop it from, because we're fearful that the market will continue to go down. So I think the human brain has a tendency, even with the best rules in place, to interrupt it because of the fear they might have or the greed.
Well, it's interesting. I used to build portfolio systems, automated trading systems, and what I realized is that emotions don't go away if you have a trading system, because if the market is making moves, is making money without your participation, then there's this you want to change the rules, you want to rewrite things, you want to tinker with things, and then you change the rules, and then guess what? The market does something, and you're not participating again, and then you're just rewriting and rewriting. So I haven't found that a totally automated system doesn't even solve all these psychological problems that we have. So what do we do to attack this?
Well, I think that's a really good point, right? You could make an algorithm that would do certain things in different markets. And that's where I think the human experience is important. I've been doing this for 40 years. I know when the bearishness gets so bad in a certain sector of the market, even if the models say we shouldn't be there, I want to go because I know that neglect of that sector is probably where the opportunity is. So I think using disciplines and tools like I mentioned, but also use some subjectivity to adapt the portfolio on the margin to take advantage of opportunities.
All right, we're going to do a hard pivot here. This week's Runway Showdown is all about investment magic and the psychological tricks of the trade that come with it. So first down the catwalk is sleight of hand. It is a master of misdirection, sporting the flash of quick trades and dazzling volatility. It is a strategy that captivates the crowd, promising immediate gratification, but often hiding risks in plain sight. Just behind, poised and patient, is the grand reveal. Elegantly dressed in careful asset allocation and long-term planning, but there's no immediate applause here. Instead, this magician savors the dramatic payoff years down the road, unveiling returns that magically compound. So James, which style holds the true magic in today's market environment? Is it the fast and flashy hand that can distract and delight, or the patient strategist waiting for the big payoff?
We think it's a patient strategist. I think that's
surprise.
Love the analogy. I think you go with the David Copperfield stage with the smoke and the big illusion.
Copperfield meets Warren Buffett.
There you go.
That.
I love it. Yeah. And, and again, adapt it. Right here, we're talking about not just being a U.S. investor anymore. Be global, adapt slowly, strategically. But yeah, keep that longer term view.
Okay, longer term view, but how do you avoid having FOMO? I have FOMO in my everyday life. You say FOMO is a mistake.
One of the 13.
One of the 13 in your book. So talk to us about that, because it's really, really tough not to feel like
pressure.
you're in the party. Yeah, exactly.
Yeah, I try to keep FOMO in other parts of my life.
Yeah,
right?
not in the stock
For
market.
the clients or my family's portfolio. But I think that it's very important. There's a lot of good information even an individual investor can use to see when people have piled into something so much that the FOMO is bubble-like. And I think we saw a little bit of that last year, where I would meet potential clients and they'd show me their portfolio, and it was Nvidia, and then other semiconductors.
XLK.
Yeah, and they had a ton of, that FOMO just got the best of them. Of course, that came to a horrible ending in the first quarter of this year. So I think really importantly, investors can mitigate their own FOMO by saying to themselves, okay, I'm only gonna have this much stock, and in each sector, I'm going to limit, no matter how I feel emotionally, I'm gonna limit how far I'm going into, let's say, technology or the semis. Create some boundaries, create some rules, and stick to them. Or if you can't do it, get an advisor who can.
I want to get back to magic here because we were talking before the show that, and the reason we crafted this particular segment is because that is part of your background. Just tell us a little bit about that.
Yeah, when my dad was a teenager, he was a professional magician. And when I was a teenager, he showed me this box of stuff that he had been carting around for decades, and sort of introduced me to that. And then I sort of took the lead and became a young professional magician through my teenage years, which was really fun.
So it seems like you're a very curious person, right? Your dad had this box, you were asking about it, you were just saying your uncle used to read the Wall Street Journal, you were telling us before the show, and that really is what got you interested in investing. So how do you utilize that curiosity in your everyday life now?
Ali, thank you. The curiosity is, I think, a driving force for what I do, and an important element to doing this. Just having that curiosity. Where are the best investment ideas today, right? When this looks expensive, let's look everywhere we can around the earth for publicly traded companies. That curiosity is a big driver, not just for myself, but I think it bleeds through my whole team at the firm.
We got about 30 seconds. Would love to hear your final views, maybe something on risk management, but I'll give you the floor here for the viewers.
Yeah, thanks. I think that risk management is the most important thing. Building wealth over the long run is really about obviously participating in bull markets, but mitigating the catastrophic declines that happen in one stock or the whole market, from time to time. So most important thing investors can do is when the market's falling dramatically, don't have the deer in the headlights type of do something, mitigate the risk. It's okay to be out of the market, or at least part of it. And getting back in later when it goes up is safer than being down 50%. If you're down 50%, remember, you got to go up 100% to get even. And I always try to tell my clients about that.
So I'm curious what you think are underrated opportunities right now. Because we talk a lot about the volatility, how that often creates opportunities. Are there sectors or companies that you're thinking, no one's talking enough about this, and you're bringing those names to your clients?
Well, I think the foreign investing is for sure just starting to come into this.
Right, people are starting to talk about it a little bit more.
And that's just the early stages. We're in the first few months of what I think is a years-long bull market. So that's one place to go. There are some ignored sectors in the market, and I think I would suggest the healthcare sector, where AI meets healthcare, makes us all live a lot longer, is going to be a great opportunity over the next 4 or 5 years.
I'd be satisfied if they get my records straight, but we are officially out of time. I've got the timing right finally, and we've got to wind things down here at Stocks in Translation. So make sure you check out all our other episodes on the Yahoo Finance site, wherever you find your podcast platforms, Amazon, YouTube, you know the drill. We'll see you next time on Stocks in Translation.